Morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today is Thursday, May 19th, and we got a few important economic data to go over today. We'll start off with the weekly jobless claims. So if you recall, last week we had a pretty high number at 294,000 people applying for unemployment. This week it was supposed to taper down to 270, but it's still on the high side at 278,000 people applying for unemployment, so not the greatest numbers there. Also, to continue that is the Philly Fed, which is the manufacturing numbers in the Philadelphia region. And again, as you can see, we have contraction there. We had back in April, negative 1.6. It was supposed to go up to 3, and it again contracted 1.8 in the month of May. So New York had some bad numbers, and now Philadelphia is showing continued bad numbers as well. However, we got the leading indicators, which is also the LEI, which is showing good numbers. It's showing that the economy is on pace to be at a growth in 2016 at a moderate pace. So back in back in March we saw 0.2%, and April jumped up to 0.6% growth. So this is pretty good. This is kind of an indicator that goes over a whole lot of data, kind of smooth things out a little bit, from like average hourly workings, average work hours, to manufacturing data, to a whole bunch of different indicators, which kind of helps us better guide us as to where the economy is moving across different industries here. Stock market's down. A lot of it is due to yesterday. As we mentioned, the FOMC was going to release their minutes yesterday by 11 o'clock Pacific Standard Time. We had, as a result, as you'll see pretty soon, the bond market tanked quite a bit. A lot of that money was going into the dollar, basically. They were investing into the dollar, which the dollar got stronger, and as the dollar got stronger, the oil prices went down. Also reaffirm what the FOMC minutes released as continued comments by Fed members that basically are hawkish comments that are out there, and basically that raised the Fed funds rate, possibly the future Fed funds futures, rate possibly going up in June. They could be possibly raising rates again in June. So this has investors concerned, and as a result, you could see a lot of movement going forward. Any good news, which would lead to potentially a Fed raising rates, you may see the stock market pull back, and as a result, and put into something like bonds. Bonds usually benefit in raising rates. So a lot of people may not realize that, but long-term interest rates, which are the mortgage-backed securities or bonds, what we're talking about here, actually a lot of times benefit, because when the Fed is raising rates, it helps protect, stave off any inflation problems, which basically erodes the value of bonds over the course of its time. So this is why a lot of times bonds will actually benefit. As you see here, we broke down below that, which used to be our the 10-day and the 25-day moving average, which was our floor. Now we broke below that, and now we're getting support of 100 and 200-day moving average. We're up about 18 basis points from where we left off. So we were way down here. We dropped down quite a bit. We were like around 33%, or 33 basis points we dropped yesterday, and right now we're up about 18 basis points. But now this floor, it used to be our floor, now it's going to be a ceiling, and this could be hard to get up above again. We'll have to kind of wait and see what kind of data can come out and see if we can get pushed up above that again. But for right now, it may take a little time before we can get up above there again. All right, folks, so rates are, well, yesterday they worsened, but today, as of this morning, we're better than where we left off yesterday. All right, folks, you guys have a great day. Thanks so much for watching, and we'll see you guys tomorrow. Take care.